Tensions rising between the big three automakers and the United Auto Workers Union just days before their current contract expires. GM offering a 10% wage increase, but UAW President Shawn Fain calling it, quote, insulting. Joining us now for more, we want to bring in Tom Narayan, RBC Capital Markets Global Autos lead equity analyst. Tom, it's good to see you. So both sides, it seems, remain extremely far apart. A strike more likely at this point, and what's the implications there?
Yeah, I think a strike is largely accepted and understood is going to happen. It's probably largely in numbers. I think what's really going to happen is you will have some work stoppage, probably similar to what we had in 2019. I think that one was about 6 weeks. Remember, 2024 is an election year, so the administration certainly doesn't want to carry this out too long. And we've done some math to show that actually, given how much labor costs are now as a percentage of total costs for the auto companies, it's a lot lower now than it was, let's say, 10 years ago. We actually think that higher elevated labor costs that may come out of this may not actually be as painful for the automakers as some may fear.
But what's the assumption when you say higher labor costs? There's a difference between a 10% and what the UAW is calling for, which is more than 40% hike.
Right. Yeah, it's a wide chasm in between the two. We actually did some math around this. A 10% increase really is only about 30 basis points of margin hit, which is really not all that much. A 20% hit is more like closer to 100 basis points, which is more meaningful, but still manageable. Now, is it going to be a 40% increase? That's obviously where one side wants. But if you split the difference, you kind of get it to that maybe 10 to 20% increase, maybe a little higher than where the OEMs, Ford and GM, are asking for right now. But like I said before, that's about less than 100 basis points of margin hit. Totally manageable, especially the other thing to think about. If there is a strike, that means work stoppage. What does that mean? Less cars made, which means pricing can stay elevated. That offsets some of the labor costs, at least near term. So, all in all, if you split the difference between where the UAW is, where the OEMs are, you get to something like 10 to 20%. It's still manageable.
But Tom, is the demand, though, going to remain at higher prices? People are pulling back on some of their spending right now, some of their purchases. How big of a risk is that in this environment?
Yeah, that's a really good question. That, to me, is more important than what's happening at UAW. Demand so far is there. We've seen pricing hold, and the reason is you've had all the stimulus that came after the pandemic, right? What is it, like $4 trillion? And we're at the last trillion. And you've also had inventory levels are low. We've had 3 years of underproduction and underbuying. They are creeping up slowly, but right now there is support, believe it or not, for higher pricing. But the question is, to your point, what happens next year? What if interest rates stay elevated and don't come down? Then leasing a car is really expensive. So the threat, I think, is really more for next year, not for this year. But to me, the pricing coming down is a much bigger threat to the automakers than the impact of a UAW strike.
What happens to inventory levels if there is a worker stoppage? I mean, how much buffer do you think there is? Because, as we talked about before, Tom, we're talking about the big three in Detroit, which are unionized, but there are many other foreign car makers who are manufacturing in the U.S. who aren't subject to a strike that can potentially take advantage of this.
That's definitely a good point. But I mean, those three, Detroit three, really do dominate the market. The inventory levels are fairly low still, based on historical levels. They've come up a little bit. But all in all, what are we talking about? I don't think it's going to be a very, very prolonged period. If it's 6 weeks, how much damage can foreign companies manufactured in the U.S. really do? And as we saw, this was still the case in 2019 as well. We saw a quick snapback with the D3. They came back right away and made up a lot of that difference. Of course, you had the pandemic and they got to put the pricing back up again. So, yeah, I do see that as a potential threat. But, if it's 6 weeks, I don't think as much damage can be done in that sense.
Tom, do you think it's going to delay the ramp up in production of EVs? And I guess how big of a risk is that then?
Yeah, that's possibly true. But as we've been hearing from the automakers in the U.S., there is this EV slowdown that's been happening. So maybe one offsets the other. One of the things that's causing that is EVs are priced really high right now. We're seeing a lot of benefits that are going to happen with the IRA. A lot of people don't realize how much money the government is transferring to U.S. car buyers and also these OEMs. So, maybe it gives them some time to get these plants up and running to qualify for the IRA. And then you get the true benefit. And that's something in Europe, you don't get the benefit of the IRA. It's really these U.S. OEMs. So, yeah, maybe near term, there's a slowdown there, but I think it picks up down the road.
Tom, there's a larger question right now about what these car companies are going to look like at the end of this EV transition. And one of the big concerns that's been raised, especially by UAW workers, is that the process of making an EV. It's not as complicated. You don't have a gas engine. You don't need as many workers. I mean, what do you anticipate the head count to be? I mean, what does all of this transition to all electric ultimately mean for the scale of the companies we're talking about right now, the big three?
Yeah, that's a really good question. And I was the European auto analyst for 4 years before I came back to the US. And I would say over there, they had this problem already, right? Because they started a few years earlier. What they basically did is they moved folks from, let's say, a diesel engine plant and moved them into making power electronics for electric vehicle components. So I do think you'll see a reshifting and reshuffling of moving workers from ICE components to making EV components. They'll try to make people whole and try to keep the headcount as high as possible. But to your point, look, there's less parts in an EV, right? Now, that said, the automakers are trying to get into making batteries. So that's a new business they weren't in at all, right? With these JVs they're doing. So maybe they can move some of the labor in that direction. So there's ways that they can kind of change where the labor is headed, maybe not doing what it used to make. But, all in, they're also talking about insourcing now away from the suppliers. I think they'll try to find a way to keep folks employed. But yeah, down the road, maybe headcount comes down. That may just be unavoidable.
All right, well, a week to go until that deadline here to reach a deal in order to avoid a strike. We'll be watching. Tom Narayan of RBC, thanks.